One of the most valuable things you can do as an investor is to study the great investors of the past and the present. One of those investors is Howard Marks. He is the founder and chief investment officer of Oak Tree Capital Management. And every quarter or so, Marks writes a memo, and these memos are incredibly rich with investment wisdom. In this video, I want to share 3 takeaways from Marks's most recent memo, which is called I Beg to Differ.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Thank you to everyone who is currently supporting me on Patreon and via YouTube Premium. You help make this channel possible, so thank you very much. So who is Howard Marks and why is he worth listening to? Marks' current net worth is $2.2 billion with a B.
That's a lot of money.
Which makes him the 1,397th wealthiest person in the world. But he's done this basically entirely from both investing his personal wealth and starting his firm, Oak Tree Capital. These memos that he writes have extremely high acclaim from one Warren Buffett. Warren says, "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something, and that goes double for his book," which is fantastic, by the way. I'll post a link in the description down below. And the reason Buffett cherishes these memos is because Marks is a fantastic investor. In a May 2014 article, Marks disclosed what is otherwise pretty private information. He says, "Our returns over the past 25 years have been 23% a year." And just for reference, if you compare that to the return of the S&P 500 over the same time period, it is about 9% per year. And he says 95% of our outcomes are positive. They've had 50 different funds over that period and have never had one single fund that has lost money. Wow. So when I read through the latest memo, there were 3 glaring takeaways that stood out to me that I wanted to share with you all. The first is that within investing, conventional behavior will result in conventional results. Let's imagine that we have a box, and that box has 4 different quadrants. On one axis, we have the accuracy of your particular forecast. So let's say, for example, you think Apple is going to do fantastically over the next decade. So at the top, we have 2 accurate results, and at the bottom, we have not accurate. And on the bottom axis, we have difference from everyone else, meaning the collective total behavior of investors. So on the right is you're acting different, and on the left, you're acting the same. In order to have superior investment results, you have to be both accurate and different from your peers. This is the only way to achieve significantly better than average results. Going back to our Apple example, let's say that you are correct in your view that Apple is going to have a great next decade, but that's not going to mean anything if everyone else also believes that, because the price of the stock will be driven up to the point where it reflects that rosy forecast. So in this case, your Apple investment would be accurate, but it would also be the same as the market was anticipating. So your results would therefore be average, or basically the same as every other investor. The worst case scenario is when you bet heavily or bet against what the consensus believes, and you're also not accurate. In this case, you're going to get much worse than average results. So in order to beat the market, you have to be here, right? You have to be better than the market and different from the market. But there's a 2-edged sword. The more different you are, the more risk you take that you may underperform. So Mark says there are 2 types of investors, basically those who want to try to be different, try to be great. Those people have to accept the risk that in an effort to be different, in a good way, they may actually turn out to be different in a bad way. And investors that just want to achieve the average result of the market should basically just buy an index fund or some collected group of investments and not try to make big active bets. And Marx is not saying there's a right or wrong answer here. He's just saying be aware that in order to beat the market, you have to be different than the market. But if you're going to be different than the market, you're going to have different than the market results. That could be good or bad. To illustrate, he talks about the Nifty 50, which were a group of roughly 50 stocks. There's no set agreed upon list of 50 stocks. But all of these businesses basically were considered surefire things, meaning that everyone thought their investment future was going to be extremely rosy, and therefore it didn't make much of a difference what price you paid for these stocks. The future results of the business would surely make up for it. And you can see that a lot of them actually did have very bright futures. For example, you see names like McDonald's, Walt Disney, International Flavors and Fragrances, J&J is here, Black & Decker, Schlumberger, Coca-Cola, Texas Instruments, Eli Lilly, Merck, American Express, IBM, Procter & Gamble, Anheuser-Busch, Pepsi, Pfizer, Bristol-Myers, General Electric, Philip Morris, Gillette, which was purchased by P&G, Marriott, Sony, Walmart, C.R. Bard, Masco, Corning, and Clorox. And many others that I did not mention still had very impressive actual business results. The problem is that in a lot of cases, the stock prices were so high that the future investment results were actually poor. In other words, the thesis that these businesses would do well was accurate. However, the opinion was exactly the same as every other investor, and as it turns out, every other investor was wrong. There was a price too high to pay, and as a result, the majority of these stocks underperformed a simple S&P 500 index, which at the time was trading at a much more reasonable 19.2 price to earnings ratio. And with the exception of Walmart, almost all of these had below average investment results, or if they did outperform the S&P, it wasn't by much. One research paper said that if you had invested in 24 of the stocks that were widely agreed upon as being in the original Nifty 50, your returns through the 2000s or 2010s, I don't remember the date, would have been just about half of what it would have been if you'd invested in the S&P 500. The second takeaway from the memo was the importance of second-level thinking. The difference between an average investor and a good investor is that an average investor tends to make average quality decisions. And an average quality decision means that it's in line with the average of all investors. And remember, all investors means hedge funds, private equity, Warren Buffett, Howard Marks, computerized trading, artificial intelligence, Morgan Stanley with their thousands of analysts. You are competing against those people. So in order to outperform the average investor, which is very intelligent, very highly motivated, you have to have an edge over them that they do not have. And one absolutely essential prerequisite for outperforming the average investor is to do what Marx calls second-level thinking. He distinguishes between first-level thinking and second-level thinking. The first-level thinker is superficial and generally has very shallow opinions of the future. So for example, maybe they think that electric vehicles are going to be the future, therefore you should invest in electric vehicle stocks like Tesla. A second-level thinker, on the other hand, would go deeper than that and say, okay, the future is likely to be electric vehicles, but how much investment's required in order to manufacture all of those? How much competition are all these companies likely to face? Is there likely to be a clear winner? What is currently priced into the market? What's the probability that I'm right? What happens if I'm right versus what happens if the market's right? So the second level thinker considers not just what's likely to happen in the future, but also what the overall market is perceiving is likely to happen in the future. And only the difference between those two is where a potentially great investment lies. Again, if everyone and their brother knows that electric vehicles are the future, you're not going to make any money on electric vehicle stocks, especially if they're kind of in the fad, right? If everyone's pumping these up as the next greatest thing, they're likely to be at minimum fairly valued and most likely overvalued just because of the hype surrounding them. And also, full disclosure, I'm not saying Tesla or any electric vehicle manufacturers are overvalued. I'm just using that as an example. The third point Howard Marks makes that I thought was really interesting was this line where he said, "Great investments all start in discomfort." So since the only way to achieve better than average results is to both be more accurate than the market and do what the market is not doing, that naturally implies that whenever you buy a particular stock that turns out to be a great investment, the most likely scenario at the time when you bought it is that there was something bad happening or there was some uncertainty around the stock that other investors were basically repelled by. And naturally, starting that investment is going to be extremely uncomfortable at the time because you don't know what the future is going to hold. Meanwhile, something that's likely to be a bad investment is one that probably feels pretty good at the time. You're naturally going to be going with the consensus view. The stock would have probably been going up a lot in the last couple months or maybe even couple of years. And if it feels good, that probably means it's the opposite. It's probably going to be a bad investment. Marx doesn't mention these examples in the memo, but I thought a great illustration of this was the difference between ARKK and XLE in February of 2021. And just in case you're wondering why I chose February 2021, it's a couple reasons. One, I actually posted a video warning people about ARKK on February 19th. I'll put a link in the description below if you want to see my rationale for that. It was honestly mostly just lucky. I wasn't calling the top or anything. It just so happened to sort of work out that way. But anyways, so ARKK, everyone and their brother thought, the future is disruptive technology, which it always is, by the way, and that these stocks basically are going to go up indefinitely and make wonderful investments. The fund was up 167.7% at the time. And so this actually felt really good. A lot of people felt good buying this stock, this ETF in this case here. Meanwhile, XLE, the energy sector, no one really felt good about it. I mean, oil was down at $50 a barrel. The economy was, just coming out of a recession. Energy had been a generally poor investment over the last several years. And the fund has actually lost 21.16% at the time. But, and this is a cherry-picked example, but fast forward the next 12 months, and it turns out that energy ended up going up 65.4%, and that's through August the 5th, today, Friday. Meanwhile, ARKK has now lost nearly 52% of its market value. Keep in mind, these are just price only, not dividends reinvested. So since XLE pays a bigger dividend than ARKK, this actually would be an even bigger gap. So the point is that if you feel a little bit bad, a little bit uncomfortable buying an investment like you would have in XLE, that's probably a decent sign that you're on the right track. Again, your thinking has to be accurate, but it suggests you're making contrarian opinions, which over a long period of time tend to work out better than if you just kind of lemming-like follow the crowd. Now, where are these going to be in the next 12 months? Well, we could see this flip exactly, right? You could see ARKK do really well and XLE do really poorly. I'm not predicting that, but that's exactly what could happen. The point is you have to have some way of determining what the intrinsic value of a business is before you buy it. If you're just going out there and buying based on, what's done well the last 12 months, well, that may or may not be a very good strategy. And thank you for watching the video. I will see you in the next one.